Okay, let's crack into it, folks. So I suppose these sorts of programs, one of my concerns with anyone in business is most of us spend an awful lot of time working really, really hard. Certainly myself and most of my farming clients largely on our own. And that is the reality of commercial reality of what we do. It also means that opportunities to come along to things like this are too few and far between. And the hardest decision any of us make is to actually get our backside on the seat in the room today. Now that you've done that, you owe it to yourself to get as much as you possibly can out of the next couple of hours. So please engage. You've just demonstrated that you all have a functioning voice. So when I ask questions, you now know it's not just there you go. And look forward to hearing your experiences. I suppose my commitment to all of you, not knowing what level you're at financially and in terms of your understanding of businesses, is to treat every question you ask professionally and courteously, and to give you the best possible answer I can. So there's no such thing as a silly question other than one you don't ask. If it's on your mind, probably on half of your mind. So be bold. We'll treat them professionally. And more than that, though, if you don't understand, if you want to challenge what we're talking about, if you've got other experiences you'd like to add, then by all means, that will add to the richness of the day as well. So jump in with me if you think of, and we'll get through the program in good order, and look forward to exploring a bit more of that with you as is appropriate as well. So that's sort of the mindset we want to approach it with. Get as much as you can of it. The program we're going to go through, this is an abbreviated version of a workshop I set up many years ago with a colleague of mine in South Australia. And we were, who's also an agricultural consultant, and we were dealing with a group of farmers in the South Australian Victorian Valley, so northwest Vic, northeast South Aussie. And this group of half dozen farmers essentially did no financial reporting, no financial analysis of their business, other than their annual tax return. So they account once a year. And working with them, they came to us and said, look, we're not quite sure what the point of all this is. We just signed off on our 6th year in a row of making a loss. Okay. Well, this is rubbish. We're going backwards. We must be. And when we sat down and worked with them and had a look at what happened, what we found was they weren't actually making what we would call a loss. They were making a taxation loss, which is quite different. And yet that was the only reporting they were doing, and they had no understanding of their tax return and what was in it for, and how to interpret it, and how to truly read their business performance. So we started this workshop because the vast majority of businesses don't do without a formal reporting, and legally every business in the country has to at least once a year go and see their accountant, get some account reports done. So we set up this workshop on the premise that it was low-hanging fruit. Every business has some financial to analyse. It was one of the most misleading documents you'll offer to see in terms of a report on how a business is truly going. So we set this up so we can hopefully help every business in Australia. What we're going to go through today, folks, is to have a look at a case study business, which is a former client of mine. It's a farm based in southern Queensland. It's a real business, real people, and they face real issues. They have allowed me to use their financials so long as we remove their identity to protect certain who they are. So it's a genuine business, and we'll have a good look at it through that lens today. And sort of, yeah, so I don't really think what we're doing here is sort of made up or manifested. It's a genuine business that has some genuine issues. So measuring financial performance. It's a little analogous to driving your car. If you're spinning along in your car, how fast are you going? You've got a speed gauge for that. Speedo, how much fuel? There's a gauge for that too. And the last one there, you're doing 120 k's an hour or stuck in a traffic jam. Folks, measuring a business is really, really similar to that sort of mindset. We use slightly different dials and slightly different tools, but by and large the outcome is quite similar. What I was going to say too, we're looking at a farm business today. It might look quite like some of your farms, mixed farming, sheep and cropping. That's the sort of business it is. But it can equally be widgets. It doesn't make any difference whatsoever what commodities you people are producing. I was doing this workshop, full day one, a couple of months ago. I had a woman come in and she's very, very nervous because she worked in a pub, she owned a pub. And I'm not sure I put in here. Mostly farmers, there's a couple of others that see business and there's something else in town. Just going to enjoy the day. She came up at the end of the day, she had no idea that what you do would be, she was Essentially, instead of having fertiliser and chemical, I've got fertiliser, it's got gear, and you're still trading and buying and selling commodities to try and make a dollar out of it. So essentially, much of this may not look exactly like your business or the business you're involved with, just the process we're going to go through applies equally to any business that you can think of. So my aspiration for you all is that you can go home and apply the exercises we're going through this morning to your own business and come up with several years of data, because several years of data is really, really instructive. 1 year on its own, especially with the tax return. Vagaries of climate, commodity prices, management, can be a bit leading. Alrighty, so over to you lot. Got this the right way. I'm going to keep throwing to you because it's not about me talking all day. We're expecting you to put your stuff back. So, answer that question, please. And please, as we're going through, feel free to work in groups. There's some notes. So, let's just to get the juices flowing. What can a financially viable business achieve? Firstly, we've got in the short term. By that we mean 12 months in an annual trading cycle. What can a financially viable business do in that period of time? Then the second question is in the long term, and by that we mean 3 to 5 years. What can a financially viable business achieve in a 3 to 5 year time frame? Okay, let's debrief. This three over here, how'd you go? Short term. What can a financially viable business achieve in the short term?
Cash flow needs for right now.
What do you come up with?
Ability or consistency.
Today.
Yeah, we talked all about that with cash flow things. The other thing was potentially just looking at different revenue streams. So understanding getting gear on product and potentially new revenue streams and testing those.
So in the short term we can identify and create new revenue streams?
Well, yeah, start to.
How did you go with the long term?
Acquisition of additional assets. We have surviving downturns.
What else?
Sell and purchase.
What are you not doing there?
Investment.
What are you investing in today?
I'm looking for diversifying what you're doing.
So outside of the business potentially? Yep. So that might be things like superannuation, it might be things like share portfolios, properties, those sorts of things. So let's move on. I want to quickly go through these charts for you. We won't spend too long on this. The base for the financial analysis we're going to get you to do. How do businesses generate income? Sell stuff. What sort of stuff? What do you sell?
Grain,
Yep.
meat, wool,
Yep.
goods and services.
Goods and services. Cool. What's your tax return going to show?
The net position for that.
You're going to show, yeah.
It's got a revenue, a cost,
Yep.
and a profit, and it's a bit awkward in that with appreciated items from different years, and so it's not a real revenue and cost.
Yeah. So what's the point of your tax return? Why do you go and see your accountant next year? What do you want the outcome of that meeting to be? Can we use the word? Can we use the word minimise? Minimise paying tax. What do we pay tax?
Roads and stuff.
What do we pay? We are being recorded for professional integrity. What do we pay tax on? Profit. We won't pay tax. We pay tax on our profit. So what's the job of our accountant? Minimise within the confines of Australian taxation law. I want to stress that point. Within the confines of the law, make the business look as crooked as they legally can. They do exactly the same thing in my business. Not very effectively, but we all want the same outcome. We want to minimise the tax we pay. And so the idea there of the profit and loss that's presented to the accountant is to make the business look a bit crooked. I'm sorry, I can't remember your name. David popped up quickly the idea of depreciation. So we can claim a heap of depreciation. We'll talk a bit more about what that is. It gets a massive amount of expense in your business. You never actually part with the money. The income you said is stuff that we sell. What will appear on your tax return is cash sales. What are variable costs? We've got these different cost categories now. We've got variable, overhead and finance costs. We need to be able to break those down to measure how the business is going. So you can start with an example if you like. we need to get to a definition of what they are, and they're the same in all businesses. Diesel, chemical, energy potentially, depending on what you're doing. If you're in a pub, variable costs, bourbon, beer, wine, ice, mixers, chips, you're going to buy that stuff in. Then your variable costs, they're your inputs. And your revenue is sale of exactly the same items. So when farming, we buy diesel and chemical and dirt and seed. We hopefully turn it into something that goes back out typically as seed or pasture or protein. And the last set of costs there are finance costs. So folks, that's our income. Everything we produce, variable costs are all the production related costs. What's left is our gross margin. Subtract our overhead costs, what's left is our operating profit, knock off our finance costs, and what is left is our net profit. Okay, the next report we've got there, folks, is our balance sheet. It is just a rundown of assets and liabilities. It's really, really straightforward. Assets are all the things that the business owns. And we break them into two categories, what we call current assets and non-current assets. Current assets are things that are cash or close to cash. So obviously cash itself. Our non-current assets tend to be long-term assets, so life of more than 1 year. So most commonly that's land and buildings, infrastructure, machinery if you have any, that sort of stuff. And then our liabilities, assets are the things that we own. Liabilities or debts are just all the things that we owe. It's really straightforward. We break them into the same two categories. Current liabilities, debts due and payable in 12 months, typically the overdraft, tax bill, creditors, phone bills, those things that haven't been paid yet, and long-term liabilities, which are debts which have a life of more than a year. We use long-term debt to buy long-term assets. So if you're building a new factory, you're building a new dwelling to put a shop or a business in, you're buying more land, you're buying machinery, all of those things are long-term assets. We would use a long-term loan to buy them. Similarly, if you were buying a family member out of your business through succession or something like that, that's not something you're about to cash flow. If you're going to pay brother, sister, mum, dad $1 million to get off the joint, that's a long-term commitment to the business, so we use a long-term loan. We want to see that increase on average year on year. The ways we do it is to increase our assets, make that chunk bigger, and that would just move up. Or the other one is to reduce our. The last one to have a look at is cash flow. Don't want to spend too long on this. How many people in the room have been involved in preparing a cash flow for a business? Why do you do it?
Oh, it's not going to work otherwise.
Okay. Why do you do that?
Why
Want to know where the next dollar came from? Who's some ideas that you have? Yeah. You have, Ollie? Why?
Well, it's good fun, but it's your money.
The joys of working at Marcus Oliver.
Bit of fun and cash flow.
Oh, sorry.
I love it. Love it. Okay. We'll talk more about it as a risk manager. At ratios in a few different areas. We're going to start punching some numbers now. How many questions before we go on? We're going to have a look at, and we're going to show you how to calculate ratios to help us understand the business. Liquidity, solvency, profitability, asset efficiency, and debt servicing. What's liquidity? Availability of cash. And this is a really simple ratio that applies to farm businesses and non-farm businesses. Solvency. The number we're going to look at there, folks, is it's already step one against equity. Equity percentage. So if I go back to that chart there, equity is the percentage of the business that we own. So if that's our business there, if I say the value of those assets there are $1 million, that's the total size of the business. Profitability, debt servicing, this is an important one for you all to understand. Banks get very warm and fuzzy about that. Okay, so that's our ratios. The benefit of doing these, folks, and doing them every single year is to come back to this whole idea of risk management and how you're feeling about your business viability. Ratios, folks, are like they're a number on a page, like a cholesterol test. You go to your GP, they say you need to have some blood tokens, cholesterol done. That is literally a number on a page. It's an interesting exercise, but comparing a local engineering business with a bakery might not be all that beneficial. They're completely different in terms of what they do. And similarly with different types of farms. None of them have the same soil types, the same area, the same climate, the same management, all those things vary. This is a set of financials we use for this exercise. It's a set of real farm financials. So you've got livestock trading, and then you've got all of these different income and expenses streams, okay? 2024 there. So we have our profit and loss report. What we've done is take those numbers, all of those costs, and break them up for you, okay? And the last point there we've got is our balance sheet. We have taken that and broken it up too for you. We've gone through for you and allocated all of those expenses. So accounting is an overhead cost. Advertising for this business is an overhead. They advertised an old tractor in the local rag. Bank charges, borrowing cost of finance costs. Consulting fees, that is an overhead for this business. Contract work, that was people coming in doing their harvesting. That's an enterprise-specific cost, so that's variable. Depreciation gets its own special column because it's a non-cash item, so that's out there in depreciation. Donations are overhead. Drenches and dips are variable, that's over there because they've got livestock. Electricity is an overhead, that's their houses and sheds. We then take those numbers and put them into our... So that puts that into a bit of a profit and loss for you, which just makes it really simple to grab that data from the appropriate place. So if you look at where they've landed there with net assets, it's $1 million. Miles and miles off the mark. If you go, so we've gone through and revalued the land, revalued the stock, revalued the machinery. Our estimate there is that their equity is 6.9 million, not 1 million. Only 7 times more. Total assets are $8.3 million versus what the accountant had. So we've gone through and put in market value for land and buildings, market value for plant and machinery, and market value for livestock. It's the only thing we changed. Okay. All right, job for you lot now is to go through and have a crack, please, on the next page at calculating those ratios on page 11. Alrighty, other things in terms of risk management and drought preparedness. I mentioned earlier the importance of doing an annual cash flow. Doing it every month, you're seeing what's going to happen, what's coming in each month, what's going out each month, in and of itself is a very, very valuable exercise. It is nowhere near, not even in the same league as valuable as doing it and then monitoring what actually happened. That's what we thought was going to happen. That's what did actually happen. Take-home messages out of all that. Undertake an annual review of your financial performance and take a long-term view of viability. Prepare and monitor your annual monthly cash flow each year. And if you're going to change something in your business, do 2 or 3 years in advance. Make sure what you're going to change actually manifests itself in better cash outcomes over the medium term. Manage the risks you can manage, plan early and prioritise. Having all of those things done puts you in a better position to get through a tough time. Being organised, ticking off your to-do list. Except there are things outside of your control. We talked about some of these. Not a lot that many of our businesses can do in terms of government policy. Seek professional support, rural financial counselling service, bankers, consultants to help you if you need. The last one there, when things get tough, always remember, folks, you are not alone. If it's tough in your business, it's probably tough in others. It is the most important time to find the time to come to these sorts of things, to have some sort of engagement with other businesses. We always talk about when people are doing it tough, we don't look at who comes to the functions, we look at who doesn't come to the functions and give them a ring. So we work in an industry which is incredibly tough, incredibly rewarding, and has wonderful people in it. Folks, that concludes what I wanted to talk about today.